Good afternoon. This is Global Markets Daily Brief for Thursday, March the 19th, 2026. I'm Jonathan Simkovich. Iran's president has laid out the price to end this war: recognition of sovereign rights, reparations, and binding international guarantees against future aggression. The headline invites you to ask whether peace is closer, but the real question, the one that matters for capital allocation, is this: even if both sides agreed to terms tomorrow morning, how long would it take for the roughly 8 million barrels per day of disrupted crude supply to actually return to the physical market? That question, the gap between a political headline and a barrel of oil reaching a refinery, is where portfolios are being repriced right now. Here is what happened. Iran's foreign minister doubled down this week, telling multiple networks that Tehran is not seeking a ceasefire. Instead, his language shifted. He said Iran wants the war to end permanently and on all fronts, across Lebanon, Yemen, Iraq, and the broader Gulf. Simultaneously, President Pezeshkian posted formal terms, including a demand for reparations and security guarantees, effectively setting a negotiating floor for the first time since hostilities began on February 28. Markets responded sharply. Brent crude opened today above $113 after briefly spiking past $119 earlier in the session, driven by Israeli strikes on Iran's South Pars gas field and Iranian retaliatory attacks on energy facilities in Qatar, Saudi Arabia, and the UAE. European natural gas futures surged more than 30%. The Stoxx 600 fell nearly 3%. The DAX dropped 3%. The S&P 500 is struggling to hold the 5,700 level after yesterday's hawkish Fed hold. That is the first-order reaction. Let's step back. The consensus view right now is binary. Either the war ends relatively soon, as the Trump administration keeps signaling, and oil drops back toward $80 or $90, or it does not, and we stay above 100 for months. This framing is incomplete for three reasons. First, the physical market is broken in ways that a ceasefire alone cannot fix. The Strait of Hormuz, through which roughly 20% of global oil supply transited before the war, remains effectively closed to most commercial traffic. The International Energy Agency confirmed that disruptions have cut global supply by approximately 8 million barrels per day of crude and another 2 million barrels of condensates and liquids. Even with the largest coordinated strategic reserve release in history, roughly 400 million barrels over 120 days, the physical gap is enormous. Production across the Gulf has been shut in by at least 10 million barrels per day because onshore storage is filling up. Restarting that production, reopening loading terminals, reassuring insurers, and getting tankers moving again is not a light switch. It is a multi-week to multi-month logistics problem. Second, central banks are now trapped. Yesterday, the Fed held rates at 3.5 to 3.75%, projecting only one cut this year. The dot plot shifted hawkish. Powell emphasized the need for clear progress on inflation before easing. Today, the ECB held at 2%, revising inflation expectations upward to 2.6% for 2026 and cutting growth forecasts. The Bank of England held at 3.75%. Before this war, European markets were pricing in continued rate cuts. Now, swap markets are pricing in 50 basis points of ECB tightening this year. This is a stagflationary impulse, energy costs feeding into headline inflation while growth deteriorates. Central banks have to choose which side of the mandate to prioritize, and for now, they are choosing to hold and wait. That means no liquidity relief is coming. Third, and this is what I think markets are underpricing, Iran's formal terms are not designed for immediate acceptance. They are designed as a political framework for a protracted negotiation. Demanding reparations and future security guarantees from both the United States and Israel is not a stepping stone to a deal next week. It is a signal that Tehran is willing to absorb damage in exchange for leveraging global economic pain over time. The Strait of Hormuz is their negotiating instrument. Every week the strait stays closed. Every barrel that does not flow is a cost imposed on the global economy. Iran's military leadership explicitly stated they have the capabilities to wage a long war that could, in their words, destroy the world economy. You do not need to take that statement at face value, but you do need to recognize that the incentive structure does not favor a rapid resolution. My base case is that the war transitions into a lower intensity phase over the next 2 to 4 weeks, with intermittent ceasefires or de-escalation channels emerging, but that full reopening of the strait takes meaningfully longer. Brent likely remains above $100 through the second quarter, with periodic spikes above $115 on escalation headlines. The inflationary impulse persists, meaning rate cuts in both the United States and Europe are effectively off the table for the first half of the year. Risk assets remain under pressure. Now, let me frame the alternatives. The bull case for risk assets is a faster-than-expected diplomatic resolution. If Trump's back-channel conversations through Russia or other intermediaries produce a framework agreement within 1 to 2 weeks, and if Iran receives enough face-saving concessions to begin reopening strait traffic, oil could retrace toward 90 relatively quickly. In that scenario, equities would likely rally sharply on a liquidity repricing, with rate cut expectations returning to the front end of the curve. I would put this at roughly a 20% probability over the next month. The path is narrow because it requires both sides to accept terms that currently look far apart. The bear case is a material escalation. If Israel's strikes on energy infrastructure expand further, or if Iran follows through on threats to attack additional Gulf facilities, we could see sustained supply losses well beyond current levels. Analysts are no longer dismissing $150 or even $200 oil as implausible. In this scenario, the global economy enters a genuine stagflation, with the Fed forced to hike rather than cut, and European growth turning meaningfully negative. The Washington Post editorial today made the point that even after fighting ends, the inflationary and investment effects across the Gulf region will persist. I would assign roughly 25% probability to a sustained escalation scenario over the next 4 weeks. The remaining 55% sits with the base case. Here is what to watch. The first trigger is Strait of Hormuz transit volumes. Forget the political rhetoric. Watch whether tanker traffic begins to recover in any meaningful way. India has been negotiating directly with Iran to move ships through. 2 have already made it. If that trickle becomes a flow, it changes the pricing dynamic. The second trigger is the ECB press conference language today from Lagarde. If she explicitly signals that rate hikes are now on the table as a realistic scenario rather than a tail risk, European fixed income will reprice further and equities will face additional headwinds. This is market commentary, not financial advice. Markets move on narratives. Capital moves on probabilities. If this analysis was useful, subscribe to Global Markets Daily Brief and share it with a colleague. We publish every trading day. I'll see you tomorrow.